What's up, what's up? All right, in this video, we're going to break down futures versus options contracts. Kind of give you some bullet points to each one. Now, before we get too confusing into it, yes, futures is its own asset. So options and futures, they're their own asset class. But futures do have options contracts on them. We're not going to be talking about that. Yes, strategies can be similar. There's a lot of tax benefits to trading futures just in general, without ever even needing to know the other side. But we're going to talk about just futures options. I know it's popular. A lot of people they have Robinhood. They want the leverage aspect. They don't have a futures account. They can't trade it. Most everyone will offer futures. I think Webull, Robinhood don't. Some of the new pop-up ones, little quick ones, they don't offer it. I've been on TradeStation. I actually love TradeStation. There's no link or anything to sell you. There's nothing there. I personally love them. I use them. The one thing I do like about Thinkorswim, though, is TradeStation. It's quick, and for so far every brokerage that I know, you have your options and stocks in one account, futures in a different account. But on TOS, Thinkorswim, it's TD Ameritrade's trading app. It's all in one account, so you can get it all in one. Because oftentimes you'll see me in my plays, I'll be in an options play and a futures play, the exact same trade. The trade just makes sense, but I just took in both accounts. And that has more to do with allocation, capital allocation. I had money, trade made sense, so I took it. Not so much as one was better than the other. I often take an iron condor in both futures options and regular options. This, if you don't know anything, like this doesn't pertain to you, but like after a move up like this, I'll sell a call spread when it sells back off, which doesn't always happen. Sometimes we'll just go sideways. But if we get that melt back down, I'll sell the put spread, which essentially turns it into an iron condor. Instead of taking the play all at once, I'd leg in and leg out like that, which I found, just again, a little more advanced. I make about 50% more on those when I do it that way versus just taking it. Because if you ever just take an iron condor, you can take it right here and catch a little bit of medium on both and put yourself to just the risk. Wait for a pop up, then sell an iron condor. You'll make most of your money up here on the calls. Puts will be worth nothing. So when it pulls back, you'll see it cancel out. Like, yeah, you made some change here, but this went red to the south side. So I like to start with a call or a bear spread, which we'll get into that. And then if we get that reversal, because it doesn't tie up any more capital, it's the same trade, I'll sell the other side. But let's talk about insurance. Let's just talk about futures themselves. So it allows investors to control a large amount of notional value, which is important, of underlying asset with a relatively small amount of capital. So an E-mini contract, 50 shares of the S&P. So we can take this SPY times 50. I gotta get my calculator, just do all the math out here for you. All right, so SPY right now, 410. So 410 times 50. All right, so we're controlling about 20,500. Now, during a day rate, that contract will cost me $1,100. So with $1,100, I'm now controlling 20,000. That will move up and down like a $20,000 position. So as far as capital efficiency, this is why this gets attractive. People like futures because if it's about whether you want to look at it, percentages or just how much can I make, there's a very reckless way of thinking. I find this more on like Wall Street bet style trading. So I just told you I can control 20,000 with 1,100. Someone else will hear I could spend 20 grand in stocks or 20 grand in futures and control so much more. So you just take that times 20. Now you're controlling 410,000, and that I think is reckless. I like to look at it as I can spend so much less and make the same amount. I can control my risk better that way. Everything I can do is just not everything I do is better, but everything about that I found to be better. That's how you spiral your emotions out of control, and you get into some ridiculous losers. So everything about this, though, the leverage, one tick every 25 cents is $12.50. So that's what, $50 per. Yeah, $50 per point per dollar that this moves right here. Which we're now talking about a $4,000 product right here. So 25 cents. It moves fast. You can make a lot. This move from here to here is thousands, easily. All right, so liquidity. So the S&P, first of all, is the most liquid products of them all. There's the SPX, which is an options-only product, and then there's the ES. There's not going to be a problem getting in and out of these things. Your fills are going to happen. You hear a lot of fear-mongering of when you put a stop loss in, it's going to trigger and fill some outlandish spot. That's due to lack of liquidity and wide spreads. You won't typically run into that. You can when there's algos trading and there's a report coming out, and it can skip and jump. That's just buying up an order book. If you look at your type 2, for me it's called the matrix on TradeStation, you can physically see the orders being put in. You'll see like 1, 2. Now every one of those is for actually 100s. You're in the mix of that. It's not just you standing there by yourself. But with bigger institutions looking to grab up a position, they'll say, hey, I need 100. And there's, you got the 1 spot, the 5 spots, there's a couple of 7s, maybe there's a big 10 going up the order as you go. If they want to just click market fill on the 100, they'll buy up every one of those. You'll notice that a lot overnight. Overnight trading can kind of suck in futures because anyone bigger in there can move that around. They'll watch it just grab your stop right out. You certainly don't want to trade this without a stop overnight, because that's how you wake up to one of the cons of futures is you can lose more. So I just put in 1100. I'm controlling 20 grand. That skips down. Your broker will close that trade out for you, but there's weird things that can happen where it gaps, skips, jumps down way past yours. Not only did you lose your account, you woke up with an invoice, so you can get in trouble there. We'll get to the cons in a second. So we've got leverage, we've got liquidity. Now the prices of futures are the same across the board as far as all brokerages. It's a standardized thing, I guess. I hate saying the word thing, but as far as, we're using the S&P as an example, but there's a lot of things you can get into with futures. There's pork bellies, there's coffee beans, I guess the indexes, there's gold, the shiny things, oil, natural gas, propane. One of the main things for futures is to just agree on a date in the future. So this is how Starbucks does their accounting, right? So they know for the next quarter what they bought their coffee beans at. So if there is a surge in coffee price or anything like that, they all of a sudden don't have to charge $15 a cup. They can wait until they run out of coffee beans. Maybe that can subside. Or vice versa. Maybe there was a spike, so they bought it all. Then things get cheaper. But this is how they can, originally designed for farmers, right? So, hey, I'm going to sell you this bushel of corn at this date in the future. I got the seeds right here. I promise I'm going to grow it. With options, you have the right, not the obligation. With futures, that's going to settle. Now, like I said in the last video talking about futures, there was a guy who he was in the oranges market in futures, had just literal tons of oranges delivered to his driveway. Which to this day, I just want to see a picture of that. I want to see him on the farmer's market just trying to just shill these things out. Like, gotta be hilarious. After things like that, they made it to where just you don't have to worry about this too much. It's going to automatically be a cash settlement. You have to physically call your broker to take delivery of it. Which, I'm not going to lie, that might be on my bucket list before I go. I want to just take a ton of oranges. 1,000 barrels of oil probably wouldn't be fun. All right, so like we talked about before, you are obligated. That is a contract you are going to buy. That is a real thing. You're going to have it. Cash settlement, as far as the S&P goes, that's just going to be a cash settlement right there. So one of the pros and cons is the margin. You got to put up a certain level of margin. So you got to have the 11. So what I mentioned was the day rate. During the day, things get cheaper. During your options hours, it only cost me $1,100. If I'm gonna trade a thing overnight, it's $11,000. I got to hold that contract. That's its full value. So anything overnight, then it won't be quite the deal. It'll be $11,000. I'll almost get double my money. Can they get complicated? This has often been talked about as a con. Is futures can get pretty complicated. It's not. It's really not. If you've been following any of my streams, this is a futures. We're watching the movement of the S&P futures right now. Now, I choose this particular ticker. This says contracts for difference somewhere up here. But you don't have to pay for this data. I do this so anybody watching with a Robinhood account can follow along. There should be no excuses. You're watching me, you have access to this without spending a single dime. Futures are what drive the order flow. So when you look at the ticker SPY, I don't like watching just that because, again, that's like reading the book, but only the odd or even pages. You get a pretty good idea of the story, but you miss out on a lot of details. Futures are what drive everything. This is where the institutions are at. This is where everybody's actually trading. Shares are like the kid stuff. That's what they use to hedge bets. Shares, if they want Tesla or Amazon, if there's a futures for it, they're in there first. That's what's driving all the order flow elsewhere, and then using shares as their tool to hedge. So you can make it complicated, but you can really make this pretty simple as far as understanding goes. It's not too hard to really grasp this. I want to say that's without going over the. We're gonna get into some examples here in a little bit. Let's talk. So because it is so, because this will make sense here. Let's get a clean chart. Give me 1 second. All right, let's get my paintbrush out here. You buy the S&P. The S&P goes up like that. Let's say that's your actual candles. They're going up like that. With futures, your P&L will go up like that. It will be nice, clean, and steady. I often compare these as a supercharger versus a turbocharger. With futures, that leverage is there. It stays there. It is consistent. Every tick is the same. I will get into options and why some might like this. Ultimately, what you're going to end up playing is a game of matchmaking. For the market you're in right now, which market are we in? Which one's better suited? In choppy markets, I actually like futures. In a 2021 market, I like options. It makes way more sense to be in those. Because on this same movement right here, if I bought an at-the-money call, controlling 50 shares, like you would control with one E-mini contract, my options contract would do this. And you've seen that exponential growth. This is what often gets shown on Wall Street bets. I made a 10,000 return. We'll get to why that was probably a once in a lifetime thing. Why that guy probably loses all his money and just showed you that one winner. But you can see the growth is exponential, which I'll explain why. Because with options, now we'll get into that. It's an options contract. We're talking about just buying right now. You can be the buyer of the seller or both of these. If you want to go long, you'll buy. If you want to go short, you sell. Sell to open, buy to close is going short. You're going to go long, you're going to buy to open, sell to close. Where everyone wants to buy low and sell high. Pretty easy concept. That's what I do. I don't get why it's so complicated for others. They like to buy in the hype. So with options, you're a little more flexible. Futures contracts, while it is a contract, they expire quarterly. Options, there's monthly, weekly. On these indexes, there's daily for the last couple weeks that the dealers add on. That's where you get into some spicy stuff. You can quickly, if you want to turn your phone into a casino, it's through the options contracts. You can trade some crap. You can really gamble some things out here. You can piss money away faster than you think in an options contract by not knowing what you're getting into. The cool thing about that, I guess this could be a pro. Limited risk. Let's get an options contract up. So here's ES right here. ES, this is the S&P 500. This is the E-mini. This is controlling 50 shares. But let's say you're on Robinhood. You want to control 50 shares. You pull up SPY. You go to the options chain. I told you to buy an at-the-money. Now, right now, we're on June expiration. So if we were to go to June, let's go June monthlies right here. If I wanted to buy an at-the-money controlling 50 shares, look at your deltas right here. Right, 50 shares. I would buy the 411 contract. I'd spend about the same, to be honest. So we're spending, if we want to go right there, we're actually spending $1,100 regardless. $1,100 for 50 shares. Now, you don't have to pick this. Let's say you don't care for June. The move you want to make is in the next month. We can back that up. So here's today's expiration. Here's tomorrow, which is Friday. And then you got Monday, Tuesday, Wednesday, Thursday, Friday of next week. Let's say, hey, I'm a trader. I'm going to be in this for today and tomorrow. I just want to take advantage of that move. Futures contracts, going to cost you $1,100 regardless. I can control that 50 shares right here now for $350. So this delta, every YouTuber will tell you that when the S&P moves up $1, your options contract will move up 52 cents times 100 shares. It's on a per share basis. You made $52. But what that also tells you is how many shares you control. Just to get down in the nitty-gritty, I can tell you your whole account, whether you're long or short. by your whole complex strategies, everything you're in, by looking at just your deltas. Shares are hard deltas, options are soft deltas because they move. So for instance, if you guys want to know how a market maker works, if I buy this right now, I buy this call, I am positive 52 deltas, controlling 52 shares. The market maker that sold it to me is at negative 52. Now their job is to be neutral, market neutral, delta neutral. So they'll go out and short 52 shares of the S&P. Now they are neutral. So by buying this, I caused them to sell some shares short. You'll get into some endless loops like that, feedback loops. That's where you get into delta hedging, gamma squeezes, the real risky stuff that can happen, which used to happen like on Fridays. We're probably getting ahead of ourselves right now. Just know that there is some exponential risk when you're on the wrong side to these. But one of the pros is, let's say I spend the 350 bucks. Putin goes off his rocker, fires off a nuke. Now I will lose $350. I pull that crap on an ES contract. Switch it over here. So ESM, that's the quarterly. So we're on the Junes. Let's go to just the charts. I pull that crap right here. We gap down. I guarantee I don't get a fill. Not only did I lose my 1,100, 11,000, I am quickly mortgaging a house. I am selling properties to pay for that one single contract that went off the grid. That is a very serious. Oh, hang on. How do we get back? Anyway, that is a very serious con to futures, is that aspect right there. So when they say, people often tell you options are, what do they call it? A controlled risk. There's a lot of defined risk strategies you can do, but options in itself are defined risk. I just showed you, like right now, I can grab this, go 50, control 50 shares, and I'm spending 300 bucks. Melts off, I lose 300. Goes to the moon. For every dollar this goes up, let's say you don't need an options calculator. I'll show you right here on the chain. Let's say SPY right now, as I'm recording this, where are we at? We're at 410. We declare world peace. You know, boom, stimulus checks again. So we knock this thing up 50 bucks. SPY all of a sudden's at 460. Which would put this at 360. So my options contract, my $350 is now $5,000. 5,100 is what that would turn into. So as you can see, exponentially, and I'm controlling 100 shares. I'm at a 1-to-1 ratio with that. So that is this curve right here. While here in the futures contract, I'm controlling 50 shares, and it stays up and up and up. I'm controlling 50, I'm controlling 60, I'm controlling 70, I'm controlling 80, I'm controlling 90, I'm controlling 100 shares. And now we just keep going up. And I spent way less in the first place. Now, those again are fantasy moves that people will often try to chase. But that is the exponential growth of it while only risking the 300 in the first place. So you can see the potential for high returns is there. Let's get into hedging. So much like a market maker just hedges your bet, let's say you have an investment account, you're rocking some positions, and you see some fluctuations coming. Like, hey, this earnings is not going to be good. We're talking about a recession. We're headed south. Now you want to be on the short side. So when you sell your shares, that is a taxable event. And if you're not a trader, you're going to have to pay taxes on those. So let's say you want to hedge a little bit. Hedging, in my opinion, sucks. I hate doing it. Let's get to NVIDIA. It makes sense sometimes. I call them airbag plays. You know, like, hey, if we get in a wreck, I want that thing to deploy. You pay for an airbag in every one of your cars, and you hope it's a waste of money. So that's kind of my mindset on that. Let's say we grab some Junes. We're in NVIDIA. You think, man, this thing's to the moon. I need to chill out on this. You got 100 shares of NVIDIA. It's growing. You don't want to sell because you're investors. You want to hold long term, but you see some short term volatility coming in. With your 100 shares, I could go 50 shares short right now and spend, where's it at? 1,900 bucks around there. The spread's a little. It's just $18.35 per share times 100 shares. That's what I'm saying. 1,800 bucks. 19. We'll call it 1,900 right in the middle. I could spend 1,900, and as that melts off, that will eventually grow into a 1-to-1 ratio, completely hedging my bet, or save face. If I want to be completely neutral, I can buy 2 of these. So I'll spend just shy of 4 grand, and I have neutralized my NVIDIA position. As in, if it goes up or down, I don't make or lose anything. I will need to manage that. But if it jumps off a cliff, I'm fine. These will gain as my NVIDIA position sells off. One cool perk about that, they announced bankruptcy. You have 100 shares. You just neutralize this at 100 shares. What happens if they declare bankruptcy? They melt off into the abyss. You are now 200 shares short. Because remember, these will grow in deltas. You'll go from 100 shares, 2 contracts at 50, to all of a sudden 2 contracts at 100. I'm obviously giving you the extremes here because there's a lot of fluctuations in between. That'll be up to management on your part. Okay, so as far as options go, one of the cons is probably complexity. If I want to see how everyone can... I've seen so many people fail in options, it's ridiculous. I think it's why people like futures. They buy, they sell. If they think it's going to go up, they buy. If they think it's going to go down, they sell. They don't have to worry about these Greeks, the gamma, the theta, the vega, the delta. What is volatility? When is that? When theta burns, sometimes it doesn't. Gamma, that is literally the nitrous to the delta, that's the gasoline. So when the delta goes up $1, the gamma actually moves the delta up. So you got these things just rocking. And again, that's what creates that exponential growth. You feel like you got to learn something new, and there's quite a bit you can do to this. There's a lot of things you have to learn with this. So a lot of people, that can scare them. The thing is if you don't know this and you jump into that asset class, you're asking to lose all your money. You want to know why I think 95% of people fail? They don't know anything about what they're doing and they jump into it. They went ahead and YouTubed Iron Condor, but they couldn't tell me what any of these Greeks are up top. They couldn't tell me what a spread is. They don't know about being long or short, but they know what Iron Condor. It's when it stays in the middle. It's the best explanation they can give me. They're going to 100% fail. I wouldn't even call it 95%. I would say you'd have to be the luckiest. You'd have to be the LeBron of trading to come in with that knowledge and not absolutely fail inside of a month or two. So it can get complex. I was just on another stream, Strongman, Personal Finance. He said, hey, why was my AMC puts options crap? It's because the premium, and that's what I'm talking about here. This is your premium cost. How much does it cost to sign that contract? This actually isn't connected to the stock market. It will drive some order flow, but let's say we're on NVIDIA right now. They announce bankruptcy. Your shares go away. I will make 100% on these contracts. That's best case scenario for me. The person who's selling me these contracts, they might know bankruptcies in the future, just like AMC. So if NVIDIA had a threat of going bankrupt, just to give you an example, right now we're a pretty normal market. This is 1800 right now as we're looking at these. It's gone up a little bit. These were 1900, but you can see we'll stick with the 270s. We're going to call it 2 grand, right? A nice even number. Let's say the threat of bankruptcy is right around the corner. For this exact same contract, this would be more like 4 or 6 grand. Now at that point, I would need NVIDIA to move $40, $60 just to break even. So that's why when the volatility jumps in, you'll see Vega move. That's what Vega is, it's volatility. You see things get crazy. The prices get crazy. At that point, it doesn't become worth it because you need such an exponential move for that to get past that, then get going into the money, that they don't make sense. And that's often a trap that people will fall into. They finally catch this hype. Hype will drive this up. And the one cool thing is what that just changed into is the high stakes table. You got to pay to play. And you know those winners are going to be big and small. What they call theta burn is we're threatening bankruptcy. Here we go. Premiums get jacked to the moon, and then it goes flat. In that case, every buyer, both calls and sells, lost. So I know we're diving probably really into this. There's a lot of things you can do. The dangerous thing about this is every option you have, because you can spin yourself into this options gymnastics of just not managing a trade. Like, well, instead of doing this, I'll add this, I'll sell that. And instead of just managing the underlying you're actually in, you think you're going to come out by just doing 900 other options that you have, which is really, you dug a giant hole with a big shovel, and you're out here with a little garden shovel saying, well, I'll do this. Well, I'll do that. I'll sell a call against my shares. And it can give you this false sense of I'm okay while you got the house burning down. Is one of the biggest cons I see with options, is not understanding it. You yourself not being able to just cope with the fact that you're about to take a loss and you are wrong. So you try to band-aid it and get into the options world. If you truly understand the options, there's a lot of things you can do. And they certainly can help, but it can also just keep you in a position much longer than you need to be. So In conclusion, there's a lot you can do with both. I found it's been amazing to fully understand both, because as markets get choppy, I'm not paying that premium. I'm not watching my options contracts melt. I like the steady, I like the leverage aspect for capital allocation. Shares are kind of just ridiculous when you understand the stock market. You actually understand how markets work. Shares really just don't make sense. Like, that's for, again, kids, YouTubers, right? So futures will be where it's at. In a market where we are trending, both up or down, we are picking a direction and we're going at any pace, because I can manage that pace. Let's say we're grinding up or we're flying up. I can now choose, do I want a spicy contract? Do I want an in-the-money contract? I can tailor my options contracts to fit that. So in a trending market, options with this kind of growth, million times better. In a choppy market like we're in now, this crap right here, options suck. This thousands up and down. I'd have to time things so perfectly and I'd have to nail the options. There's so many other things I'd have to nail correctly to nail these moves right here, outside of going 0 days to expiration and really catching some risk with that. One beautiful thing about options contracts. So let's say you don't know about options contracts. Your one takeaway from this video is, I want to learn about options. Someone's going to start teaching you. I don't care if you buy a course. Hopefully this person's reputable and knows what he's talking about. They're going to start talking. There will never, and I mean never, if this was a typing, this would be all caps. There will never be a time where you'll make more and risk less. If you want to risk more, you'll make more. That scale will always counter. You cannot take from one and add to the other. They will always counter. If you want to risk less, you will make less. I love that play. As an option seller, I actually love that. I call it children's allowance. After a move pops up, I sell way out of the money. I sell to the gamblers. At that point, I become the slot machine, not the guy just pulling the lever. I take his quarter. I take his few bucks. And it expires the next day. And I say, hey, good job, man. You want some flashing lights? Let's try again. Like occasionally that one kid, he gets the jackpot, and I got to sell some shares. How many times you won the jackpot at a slot machine? Why do you think casinos are just 90% slot machines? I love that play. If you're going to be an option seller chasing premiums, a fool's game, you're just going to lose. I love collecting less, managing less, and just, I hate to say it, but I call it free money. I'm not selling any pipe dreams, but man, I make a lot of just free money doing that. But if you want to pick the direction, you want to be an options buyer, and you catch that right move, exponential. You do it in the indexes, you catch it with a futures contract, and you just keep trailing it, banging. I totally missed one of the biggest pros and cons. Futures, round the clock. Options, for me, 8:30 to 3. That's that. They're options. Then the next day, I hope it gapped in my favor or stayed where we're at, because theta's kicking in, and if it didn't gap up, I'm already knocking some back. Futures close for an hour. They take a brief little nap. I can manage it around the clock. So that's why in choppy markets, I don't want to wait till next morning. Holy crap, did somebody tweet something? Did Putin go off? What did the other side of the world do when the sun-up was over there, and did that just wreck my account? In the futures world, I would have stopped out. I would have woke up to, hey, World War III, I stopped out. That's cool. Wish I would have went short. Had you been long and they announced that, you could have been long up 1,000%. A crazy tweet gaps it down the next day. You went from up 1,000% to negative, especially if you're trading some out-of-the-money crap. Personally, I don't care for out of the money. I like selling those. That's where the gamblers hang out. If you ever want to find a gambler, just know he's probably giving it no time, and he's probably out of the money. Very slim chances that they win. Anyway, I'll wrap it up here. That was probably as basic as I could make it. There's actually so much more to this. But anyway, let me know if you like this. Do we need to dive more into options just in general with capital efficiency? Jump in the live streams, ask questions, let me know, and I will see you guys in the next video.